Afternoon, ladies and gentlemen. Welcome back to another stream here. You guys are going to be seeing a lot of me today, especially for those of you guys in the mastermind, but it's that time of day. Happy FOMC day, ladies and gentlemen. We have the interest rate decision coming on in about 15 minutes here. And then we're going to get the prepared remarks from Powell at 2:30. And then, as always, we're going to be paying close attention to what is said during that question and answer session. Let's kind of go through a little bit of a warm welcome to everybody in here. Again, let's do a little roll call. I know we do it in the mornings all the time, but let's do another roll call for everybody in here. If you guys are new to the stream, welcome. Let me know. I love to say hi to you guys. And as always, ladies and gentlemen, and especially for Powell here, make sure you guys are hitting that like button on the way in. Helps get these streams out to some more people here. Let's have some fun. Again, those of you guys that want to trade this, I mean, you're gambling. I'll just tell you that right now. You want to trade Powell, you're gambling. Hopefully you guys make smart decisions and don't do anything too crazy. There are some things that I'm looking at potentially taking positions on if I hear certain things that are said out of Powell's mouth. And then how the market is going to be reacting to those things here. But let's see, ladies. Oh my God. Welcome, everybody. How are we doing? John, Rogue, Tor, Dr. Bob, Ben, Boric, Lofty, Eddie, Hawaii, Wreck-It Ralph, Nate, Romeo, Blue Arrow, Rana. Good afternoon, ladies and gentlemen. I see all of you guys are now slacking on the like button. I see how that goes. But let's see what we get here today. So let's kind of go through a couple of the main things that I'm looking for out of Powell. There's really two. I want to see what his comments are in relation to the slowing down of the balance sheet runoff. If that happens, I think yields could easily start to move down, and we could easily see the market start to pick up off of that. Again, I feel like this doesn't even need to be said, but it is highly unlikely that interest rates are cut or raised at this meeting. I really don't expect anything to really happen with interest rates until this fall now. I mean, September kind of right along with market expectations. Maybe we get one a little bit earlier, but that's really it. So we'll see. We'll see. And then the other thing is how Powell is going to be reacting to GDP. So again, he had said in the prior FOMC meeting that he expects GDP growth to slow and unemployment to go up. We've started to see GDP growth slow, but we haven't necessarily seen that unemployment number go up. What I think is the most important thing to look at in kind of relation to unemployment is you have to think about like what the unemployment rate going up actually means. It really has to do with the strength of the consumer. So to me, looking at the overall strength of the consumer is a much better way than just like reading the unemployment rate, you know? Like, because if a lot of people are going to be out of work, you could see less demand coming into the overall economy. Again, not great things happening, but it is going to be something that we kind of need to see in order to start cutting rates. Now, what we've seen a lot recently is that those numbers that are showing great additions to part-time employment. So what that is effectively showing everybody is, well, if people are then taking on part-time jobs in order to meet their day-to-day needs, well, they may not be getting fired from the job that they have. Like the overall strength of businesses, again, they don't need to fire people at this point. We've kind of gone through that, all those layoffs that we were seeing in kind of 2022 and 2023. But even the jobs that people have aren't necessarily enough at this point. You can see it in credit card delinquencies reaching 2008 highs. You could see it on what I posted for you guys on Twitter yesterday, that survey that like 43% of these smaller businesses were unable to meet rent in the last month. So that's not a good thing to see. TMF here. I mean, I do have a little trade setup put here, but that's really only to see where the risk might be. That's it. I am interested in this Lebu. I wish this thing would just relax a little bit because as we were talking about, obviously on the morning streams, like you'd have to see, or I mean, what we've been talking about on the streams is, well, if we start to see rates coming down, there's going to be a lot of interest rate sensitive trades that could happen. You're seeing it with biotech starting to come. That's a little bit of a risk on type of trade that you're seeing. You could easily just go for like the TLT TMF if that's going to be the case. RKT is another one I'm thinking about. The setup. Wait, let's take a look at RKT right now. How is that looking? That's getting there. RKT actually doesn't look that bad here. Let's see. Why did the NASDAQ and the S&P have the same price action? It's the same algorithm. Like the overall markets are always typically going to move together. You're not going to see like one go up a bunch and one go down a bunch. Google just announced layoffs in the U.S. to rehire less expensive foreign labor. That's not good. That's not good. All right, guys, we have 10 minutes to go until the interest rate decision and kind of the initial remarks. I would be very interested to see if there's anything about slowing the pace of the balance sheet runoff in this prepared remarks. I feel like there will be. Other than that, it's really just GDP and then kind of how people are going to react just in general to the questions that Powell is going to be receiving. Uber pumping? Yeah, I mean, I don't really care like about anything. Can I Green Guy new to the courses? What's up, buddy? How you doing? Can I look at CGC? That's already made the move. I gave you guys, if you guys were following along on the streams, ACB last week. I mean, this one started off hot, came back down, never stopped you out. I actually was out of this one in here. I just didn't like the rejection out of the zone. Obviously, should have held it. You came up to TP1 yesterday. But I would say CGC is probably going to look the exact same. Yeah, no, this is nothing. I mean, great setup here. CGC actually had a little bit of a better one. Yeah, I kind of wish I took the CGC instead of the ACB, but again, I mean, we had already nailed the 1-16 risk reward trade on the ACB with the Swing King scores. So I mean, it's been nasty. So we got to have another good month, man. I mean, last month up over 20% on the swing account, crushing it, man. So again, I mean, that 50% off deal to all the education. I mean, we can say it now, but like that's ending at the end of May. And then my morning streams, we're transitioning those into for all of you guys in the courses twice a week. So again, it's going to give me a lot more time to make a bunch more content for you guys, shorts, long form on YouTube, more Twitter threads, giving you guys more of that information within VIX Insights too. We have a really good one about interest rate risk coming out. I'm going to see if I can get that one out for you guys this weekend, along with the single stock write-up on something that I'm really interested in, a cool company that I think a lot of people don't understand is actually you can have exposure to certain things in the market with this one. So that's going to be a fun one. Freaking Leboot, relax. Chill out. You don't have to move this much yet. Jeez, man. CGC looks like it fits in the range. No. CGC looks terrible right now. Why would, again, CGC looks terrible. No. But this was the news that I was anticipating on all the weed stocks there. Ideally, I wanted us to be able to hang out in here as this thing was moving up. And getting that, what do you call it? Getting that news coming up, potentially hitting this TP2 in one day. I mean, that's kind of how this one went. This one was filthy. Those of you guys that saw this one, dirty. We had DJT. That was another wild one from this week. I mean, this thing just went from 38 to 50, came up here, almost sniffed that second take profit there, but didn't quite get there. That was a fun one. I had the options on that one. Only was able to get like 150% on those. I just wish I took the shares. But we've talked about that one enough. Oh yeah, Green Guy. No. You don't use that on swings. Yeah, you don't do that on swings. You got to use the Swing King score strategy on the swings. That's gonna really turbocharge things. Yeah, you don't. Maybe every once in a while I'll look at it on like indexes, like the S&P, but other than that, no, we don't use that on swings. All right, team. We got about 7 minutes to go for Powell. As always, make sure you guys are hitting that like button on the way in. Helps spread these streams out to some more people, team. Again, cost you guys nothing to do. It helps me out a whole lot. Make sure you guys have notifications on for the channel too. I'm going to be trying to get out a video recapping everything that is said by Powell in this FOMC meeting tonight. So again, we're going to be listening to it here. I'm going to be taking notes, kind of making some comments every now and then. If I find something's very interesting, but you guys are going to get that full video breakdown later tonight. The crime was late today. Yeah, we didn't have any crime on the morning stream. Leboot, chill. This one is interesting. There's a couple of reasons for this. I mean, we've talked about this enough. The TMF and the rate trade about kind of where people are headed and kind of how the market likes to pendulum swing back and forth between all the expectations. Well, David, here's the thing. It's very similar to what we've been talking about with earnings. Like, first of all, if you're going to trade at this time at all during, like, in 6 minutes up until the end of the day, you're gambling. You're just gambling. What happened to ACB? I don't know. It just sold off. You slapped a TP1 and then it just sold off. Another gem. I mean, they had that great news yesterday, sold off today. I don't know. See what happens to it later in the week. If you guys got that entry last week, though, when we were talking about it, another gem. Where's Yin? Yin's up 3%. I like that. Everyone else slapped TP1 too. Yeah, I didn't. I mean, I took a little tiny gain on that thing, but I was like, I don't really like how it looked. PDD is looking interesting. I like the look of PDD. DJT kind of did that today though too. I mean, what, we hit TP1 yesterday. You were sniffing TP2 today. Didn't hit it. Okay. Again, you guys got to realize once you hit that TP1 and you're, especially with shares, your job is over. Your job is over. All you got to do is just stops to break even, target TP2. Comes in, stops you out, great. If it doesn't, keep it going. I mean, this is TP3 up here. If this thing really wants to get going, you have like a potential 1 to 18. Mike Britt, welcome back, buddy. It's been a while. Had to step away from the market for a while, but back now. See, you're still putting out excellent info. Keep it up. Thank you, buddy. I appreciate that. MNQ looks like it's climbing to the top of the 15-minute orb box for people trading Titan. Well, orb, I don't think is a Titan. I don't know. I mean, I've got no idea. Lebu doing its thing. I want to see what Baba wants to do on this. I mean, we have yin up here. We don't really need to look at yin. This is just a shares position I bought like 9 grand of it, like down in here somewhere. That was good. I mean, I still like, there's two competing parts in my brain right now that I want everybody to get caught off guard with what's going to happen in this this FOMC meeting, which I think is incredibly possible for it to happen, because everybody is expecting Powell to be incredibly hawkish with the GDP data. Not mainly the GDP data, but mainly like CPI, PPI, and things like that. And people are going to expect him to be very hawkish. Now, if he comes out and talks about the balance sheet runoff, the market's going to eat that up, because you have the Treasury starting buybacks, which is kind of an insane thing to do. You have the Fed, who said that they were running off their balance sheet, but they really didn't all that much. If you look at the data of what the Fed actually accomplished when they were effectively just selling the assets that they had, they didn't do that much. So doing this again and kind of slowing that pace from, I think people are talking about, what is it, like 60 or 90 billion down to 30 billion a month. And then when you think about what the Treasury is about to do, they're going to be buying between $8 and $10 billion worth of securities every single month to provide liquidity to the Treasury market. Interesting. Interesting there. All right, we got 3 minutes to go, ladies and gentlemen. You guys are crushing the like button. Thank you. I appreciate it. I don't really have anything here. I mean, I got a tiny starter on Baba just as like a placeholder. Other than that, I got nothing. I want this. This is the one that I want. And this. This I do want. I want to see how this can go. But I kind of want to... Hold on. Instead of yen, let's get the 10-year. And then I also kind of want to have USD JPY up here as well. I mean, we could just leave it. I kind of want to look at the dollar. I want to look at the dollar instead. JT, what's up, buddy? How you doing? All right, guys. I hope you guys are excited for this. This is going to be an interesting one. I think the potential for people to get caught way off guard on this FOMC meeting is pretty high. Again, who knows, though? Who knows? You never know. Powell could come out full hawk, which I don't think he's going to. That wouldn't make a whole lot of sense for him to do. And then again, in this is like pretty important coming up in 2 minutes, but in 30 minutes is when it really starts to get important with Powell's prepared remarks, which obviously we will stream, and the question and answer session with Powell as well. Lebu, relax, bro. Stop. You're not going to give me a good entry. Where's the 10-year? The 10-year starts selling below here. This thing's going to go. We'll see. Mo, what's up, buddy? How you doing? Welcome, everybody. We've got a little less than 2 minutes to go. We have a minute to go now. A minute to go now. Netflix ripped up? That's interesting. Yeah, well, also, your first VIX Insights research report is out. That's a good one. And then we're going to have those single stock write-ups coming for you guys this week. And then I really want to make the one about just teaching you guys about how, like, what the Fed has effectively done with interest rate risk. Like, they've kind of removed it from the market, but the implications of that are so important. And you guys have to understand these things in order to have long-term success in the market. So a lot of people just like to come in and be like, ooh, I want a cookie cutter setup to trade and I'm going to be successful. No, that's not how it works. Sorry. You got to understand the market as a whole, all of the different economic factors in order to have that long-term success. There you go, Lebu. Sell off. Did I go shares? I have shares on yen. In Japan, welcome, welcome, welcome. Yeah, I went shares on yen. It's in the big account. So I don't trade options ever unless I'm selling them in the big account. All right, here we go. Let's see. Yeah, that's probably that. We'll see. Let's see if this is balance sheet runoff. Yeah, unchanged interest rates. All right, here we go. The Fed marked in its marked to its hold on. The Fed marked to market its policy statement to acknowledge recent inflation setbacks, but didn't change the guidance section. In June, the Treasury redemption cap will fall to 25 billion from 60 billion. Yeah, here it is. Here it is. Beginning in June, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from 60 billion to 25 billion. That is here we go. That's that move we were looking for. So that's going to cause yields down. I would say Lebu's probably going to go a little. That's what I was looking for. So let's see if we can get this. Where's the 10-year? Is it dying? How's the 10-year going up? Yeah, there it goes. Hold on. Give it a minute. That's interesting. Yep, slowing the pace of the runoff. That is incredibly important. Do I do it? Market's not reacting yet because that's what's going to catch people off guard because they're just going to look at interest rate decision and Powell's tone. But the actual actions from the Fed are what's the most important. Take a trade. I'm not going to day trade it. FOMC flags lack of further progress toward inflation target in recent months. Yeah, that makes sense. I kind of want the TMF. That's got to push rate cuts to 2025. Slowing the runoff doesn't. That actually would mean the opposite if they're slowing the runoff. But it more so has to do with other factors. Like, where's the dollar? Dollar down. See, I think this is going to go. I don't know, though. I'd rather have this. Honestly. I'd rather have the Lebu. What's the risk reward? This isn't really moving. Market's not moving. Baba's back up a little. Where's PDD? Dollar's coming down. There goes TMF. Yeah, there goes freaking Lebu. Stop it. There it goes. Oh, that thing just went. Let's see. USD JPY. Yeah, where is it? Let me look. It should be down. Yeah. Yeah, there goes TMF. Oh, Lebu back down. The risk isn't great here. Where's the 10-year? 10-year dying. That's what you want to see. Hold on. There it goes. See, that's what's going to catch people off guard. I gotta do the math quick. I don't know if I'm going to do it right now, but I'd like to. Freaking Lebu. There it goes. A piece of garbage. Nope. Fuck. There goes TMF. Dude, I knew it. They just didn't want to let Lebu chill. Oh, man. I don't think they're going to give me this. I was going to market order it, but market should be popping. Yeah, there it is. See, it's just catching people off guard. Let's see. Yeah, USD JPY down, Lebu up, everything up. Where's Baba? Baba coming back. That actually isn't bad. I just want to see what the risk looks like because that's the one that is just the direct trade on it. Oh, no, back down. Why is this not moving and Lebu is? Where's the 10-year? 10-year's not budging. That just could just be a nonsense candle here. TMF just got slaughtered. What's going on with the 10-year? It's flickering. There goes Lebu back down. Market coming back down. I might give this a minute. I don't know. I want it. I mean, you guys have seen that a lot of things that we've been talking about. I mean, a lot of things are pointing to rates down. So if that ends up happening, well, you would see things like LABU, TMF, those types of things start to run. That actually is a really interesting move that it's doing right here. Lebu's just pushing. That's just risk on right there. Look at this thing go. I knew it. Cannabis reclassification postponed. Oh boy, they're screwing with everybody there. They're screwing with everybody. Damn, Lebu. There goes. I mean, XBI is probably going too. That's the unlevered one. See? Right there. Boom. I can't take it now. The risk is it just kind of ran away. The spreads on that thing is hard. Like I wasn't going to market order it. Hold on. All right, let's see. I didn't see that news come through. The cannabis stuff. I mean, we saw the news yesterday that they hit it. Hold on. All right. Now we can kind of settle in here and let things go. 10 years just kind of whipping around. All right, what do we have? 22 minutes to go until the presser starts. That's going to be important. Where's Baba? Kind of chilling. I like that. Yeah, Wayne, of course it's live. What do you think it is? Of course it's live. But again, team, as you guys are filtering in here, make sure you guys are hitting that like button on the yeah, it was proposed yesterday. I would not expect that to have actually happened. Like why would they announce it one day and then stop it the next day? That doesn't make sense to me. But we'll see. We'll see. Rate cut? There is no rate cut. We're not getting a cut for a little bit. Interesting first candle here. Dude, Lebu just ripped. I was trying to get this thing at like 96. And it's just at 98.87 right now. It's up 8.8%. I think that one's going to run away from me. I think that one's just going to run away from me. That's fine. I mean, that's the one I want, though. But I mean, if the rate thesis is correct, look what happened the last time rates went down. November. This thing went from like the 50s to 175. So we'll see. When do we buy calls today? How about don't gamble? How about that? Come on, guys. Let's be smart in the market here and not be dumb. Okay? Thank you very much. Let's be smart in the market. You don't gamble Powell. The only reason why I'm looking at anything right now is because slowing the pace of the balance sheet runoff. That's it. That's it. And those potential rate trades that could come with it, like a Lebu or a TMF. That's it. Right now, this FOMC report is a dud, though. Nikki Leaks is posting. Oh boy. Here we go. Before, risks are moving better into balance. Today, risks have moved toward better balance over the past year. That's interesting. Yeah, but the most important part of this is beginning in June, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on the Treasury securities from 60 billion to 25 billion. The committee will maintain the monthly redemption cap on agency debt and agency mortgage-backed securities at 35 billion and will reinvest any principal payments in excess of this cap into Treasury securities. Means they're buying. Means they're buying. Let's see. Watch TMF here. Where did this hit a high of? 45, 48. Okay. I mean, this will go up to here. And we'll see what happens. Watch the 10-year. Where's USD JPY? It moved back up. Dollar's probably moving back up a little. The market's not doing anything. Market's not doing anything. Bitcoin's trying to get back to 58K. I wish I kept the biddy. I had a lot of biddy. What else are we looking at? Lulu invalidated, I think. Lulu broke down. We're not touching that. PDD is the other one that I've liked. Yeah, there goes P. I don't have this. I was just drawing this out today for fun just to see where the risks and rewards would be if I wanted to go shares or options. So I don't have this one. This one's on my radar though. Those of you guys in Swing Kings, I mean, you guys know exactly what we're looking for. The LLM isn't showing me enough. I think it's a dovish release. Oh, to think it's a dovish release? I don't think it's a dovish release, but you know what people are going to hang on to. That's what I'm saying, is that it's not a dovish release. And the things that Powell is going to say are not necessarily going to be dovish at all, but he's probably going to be a little bit less hawkish than people think. And then the slowing the pace of the balance sheet runoff is going to be very, very important for yields, especially with the QRA today. Again, we've been talking about this for a while. What did we say? QRA is going to come out and announce buybacks, which was this morning, which then showed that the Treasury is going to be buying between $8 and $10 billion of Treasury securities per month. And then we saw the Fed slowing the pace of the balance sheet runoff. Okay, well, all of these things are now pointing to the possibility that yields could be heading down in the near future. Then when you combine that with all the USD JPY stuff, especially with what I was teaching you guys within VIX Insights, a lot of that is potentially pointing to yields down too. Now, what you have to really pay attention to is, okay, well, what's going to happen with the dollar? And then what is going to be the reaction from Japan, especially after today? Again, we are going to get a lot more important comments from Powell in this FOMC prepared remarks and question and answer session. But again, you shouldn't be day trading this. That's insane. Anybody that's saying, oh, let's go day trade FOMC is honestly trying to make you guys lose money. Ten-year's not really moving. It's an interesting wick up, though. I'm surprised that this wicked up at all with that. Lebu, man. That mother effer. Just would not let me get my entry on it. Riot had great earnings, 150% upside from on their production of Bitcoin there. Yeah, well, I want those to absolutely capitulate. I want Mara to just get down into my launch zone, and then we can play it again. Like, you guys have seen, like, the 1,200% Mara, the calling it from 1066 to 30. That one was dirty. So I just want it to give me that opportunity again. If it does, awesome. If it doesn't, okay. Let's see. Oh, hold on. Ooh. Yeah, there's a lot of interesting things happening with China stocks here too. Do we use the daily chart to check the range for swings? Green guy, I'll say this again. That's not what you do on the swings. Again, if you're in the Swing Kings course, you use that strategy. You don't use the day trading stuff on swings. DRV home builders and residential real estate not reaction to potential yield decline. No, you're right. Hold on. Where did that move? That's interesting that this is green. Where's KRE? KRE's up on that. So this is also thinking yields down a little. Nothing crazy though. But yeah, green guy, again, if you're in there, and I said that before, make sure that you're using the Again, if you look at all my swings that I'm taking, it doesn't use that one at all. Sorry, just misunderstanding it so right now. Yeah, well, again, that's why there's those two courses that you guys. Well, also there's that 50% off deal that's ending at the end of the month, but yeah, it's you use the Swing Kings course for it, which is how we nail ACB, DJT, and all the other stocks in the market that expire that are about to explode before they do. Baba, PDD. This one's moving interesting. I don't have this one though yet. I'm gonna give that one some time. So Powell is probably going to talk about the runoff of the balance sheet, and he's also probably going to get some questions on it as well. So make sure that we're listening to that. That's going to be something we talk about a lot in the YouTube video coming later today. Let's see though. We got 14 minutes to go. There we go. Yeah, no, asking questions is a good thing. Just make sure you're listening when I respond to them. Ralph, look at what KRE is doing. That is not saying yields up at all. Neither is Lebu. This thing moving like this is not suggesting that. Look at this thing. I couldn't even get an entry on this. That's how fast it was moving. Made PDD free. There you go. There you go, Ben Currington. Yeah, I mean, if you were slinging like weeklies on it, you probably were able to do that. Baba 75. This one has my attention. Baba is very, very, very interesting to me here. Let's see what happens. HYG is nearly green. Right. See, that's not suggesting yields up either. What about is it J and K? No, that's high yield. LQD. That's investment grade. What's investment grade doing? It's trying to go green. HYG. HYG is, I mean, when did this move? Oh, come on now. Come on now. Yeah, it's a lot of these things are suggesting yields down. So we just have to wait and see what's going to happen. The LABU here, though, I mean, I wanted it. I just couldn't get the entry on it. QT tapering begins. Yeah, so let's see. There it is. That's so important. Like, we're going to go over this in the video tonight, but that runoff on the balance sheet is the most important thing that like big money is going to be paying attention to. What else? This thing's moving. Where's Baba? It's just chilling. Baba's just chilling. Sometimes I wonder how many tickers Vix can name off the top of his head. Probably a lot. I would have to start alphabetically, and I could go through a lot of them. You'd like to see residential real estate home builders move more with the data. That's personally right. Yeah. Well, how is lumber reacting too? Like, what is it? LBR? Is lumber reacting to this? Not really. You're not getting a reaction out of lumber here. Oh, the other thing I want to look at here too, SLV and GLD, silver and gold, those should be up. Yep. So silver's up 1%, but I think they already were up today. Gold came down a little bit on that. With the dollar doing what it did, where's the 10-year? Dixie. Dollar's pulling back up a little. See, like, even though there's a lot of things that are pointing to like potentially yields lower in the macro space, like this dollar chart just looks like it wants to rip. But again, though, like you're right with DRV, like that doesn't make a whole lot of sense. All right, we got 11 minutes to go until the most important part of FOMC happens, ladies and gentlemen. I hope you guys are as excited as I am. I'm going to be taking a lot of notes during it. It's going to be fun. Oh, I ran out of coffee. That's no fun. Carry not really reacting. No, right now it's a dud. Like this thing is up a little bit, but overall this has been a dud. I want to see when KRE reacted though. Was this move up all day or was this? Yeah, no, you're right. KRE has done nothing. But what it's also suggesting is it doesn't think yields are up. Like what this move in KRE is kind of suggesting. I mean, now it's starting to lose a little bit. If this thing starts selling, that's not going to be great. That will kind of be like it'll hurt the thesis a little bit if they start selling KRE here. And you'll kind of see that here. If bond yields start coming back up, this is the 10-year treasury yield. If this starts to move back up here, I mean, you're going to see TMF go down. You're going to see KRE go down. You'll probably see the dollar up, GLD down. I don't think you'll see a big reaction out of China. Where's yen? Yen up 3.38% today. That's good. Print my shares. Print my shares. Let's see. All right. Let's see. 9 minutes to go. Nothing on carry. Nothing on TMF. What else could we look for? Let's get, how is LABU doing? Is that thing still kind of moving with the market here? Or is this, dude, look at this thing go. I was trying to get this down in here. I couldn't get it. I just couldn't get it. So I'll keep an eye out for the TMF, which it's holding. Nobody's really doing anything in the 10-year. What about the 2-year? 2-year, same look. What about longer duration? That's interesting. Is it wrecked? What do you mean? Is what wrecked? Romeo, what do you mean? Is what wrecked? One thing. We got 8 minutes here. I mean, let me get the Powell stream actually up. And then we're going to be taking a lot of notes on the Powell stream. This is going to be interesting. Right as he says, good afternoon, things are going to start moving. You looked at top. Yeah, it's nonsense. I think that's one of those China pump stocks. But again, I feel like you guys will see the light eventually. Like you guys see it in Swing Kings, like what we've been able to do. Like this one nasty, this one nasty. DJT. What else we got? DJT. This one. I mean, it doesn't look that crazy now, but this was still like a what? 1 to 4, 1 to 5. That's crazy. What else? The SLV that we had was pretty dirty. This one was 535% on the options. That was dirty. During the presser? Well, it depends. I mean, right now he's again he can't really come out and be a dove. It's gonna be very hard for him to do that with this data. The only thing he could say is, all right, well, if oil prices go down, it could get us back on track with going. I mean, I don't think they're gonna get to their 2% inflation target. I'll say that, but like the main thing is he going to be as hawkish as everybody thinks he's going to be? And I would say no. And bond yields are kind of suggesting that too, especially with the balance sheet runoff. Yeah, see, Daniel, I mean, that's why I say all the time, if you guys, you're gambling, man. Plus, Daniel, didn't you just get those Apex accounts? Come on. Let's be careful with those. TMF starting to move back up. That's nice. Let's see if that thing can get some juice. LABU running up potentially to 99 right here. Oh, my Lord. Yin's up nice. Does that mean Baba and everything else is moving? A little bit. Not really. Not really. Quantitative teasing. That's funny. UBS, the Fed QT tapering in June is a dovish surprise. It is. Not just the timing of the QT tapering, but also the amount. Yeah, I think a lot of people expected them to go to the from 60 billion to 30 billion, but they went to 25. Like, that's dovish, guys. Like, that is not, like, it's not what they should be doing right now, but I mean, it is. And that's kind of what I was expecting them to do. They did keep MBS the same, though. We got 5 minutes here. 5 minutes here until it gets real important. 20. Whoa, look at the 20-year there. That's a buy. Somebody bought that one. 10-year, same deal. What happened to the rates? Nothing. They didn't do anything with rates. The most, again, like I was telling you guys about on Twitter, and we talked about this morning in the morning stream, the most important thing that we needed to pay attention to is more information on the pace of the balance sheet runoff. And how much are they going to slow it? They're going to be slowing that pace a lot more than people expected. So instead of 60 billion, it's 25, and the expectation was 30. So with that combined with the Treasury buyback program, it does look like yields want to come down. We got to pay attention to the dollar. The LABU. I tried to get it, man. I couldn't snag it. Dollar coming back down. USD JPY should be doing the same thing. A little bit, nothing crazy though. Phoenix, what's up, buddy? How you doing? Guys, remember, we're live every day on YouTube at 9 a.m. I don't know where you guys have been, but we've been live every day. Make sure you guys have notifications turned on for the channel because we're live all the time. Is Yellen running the Fed again? 100%. 100% this is Yellen. Even though they're all going to say no, and the people are going to be like, no, it's not Yellen. It's just the Fed. It's Yellen. It's Yellen. Silver up. Let's see. Spy's running. That makes sense. This makes sense. This is catching everybody off guard right now. People who are uneducated about the market, I mean, they're going to think that, ooh, Powell not cutting rates and saying the inflation's not going down. I mean, that they're going to really like lean into that when the most important thing is the dovish surprise with the runoff of the balance sheet. Which, Ralph, remember I sent you that message earlier. I was like, I have a sneaky suspicion that when they start talking about the pace of the balance sheet runoff, they're going to pump this thing. There you go. It's like 20 points there. I bet Lebu's over 99 right now with that. Yup. That's annoying. All right. It's almost time for Papa Powell, ladies and gentlemen. Here we go. We have 3 minutes. Again, team, make sure you guys are hitting that like button on the way in. Yeah. I mean, again, you guys know that 50% off deal to All My Education is ending at the end of the month. If you guys want to give yourselves that fighting chance in the market and actually trade how, like, if you want to have long-term success in the market, I mean, those are things you need to understand. Like the Swing King scores, you guys have seen all the results from it. I've been posting a lot more testimonials on the Instagram. I mean, you guys have been having so much success with those strategies and the watch list that I send you every single week. The day trading mastery course, though, that strategy just speaks for itself. It's had like 16 winning months in a row. So, I mean, I can throw the link in here once for you guys, but that 50% off sales ending at the end of the month. And it's also when the morning streams are going to be ending, and we're going to be doing 2 of them, every week for you guys that are in there, because I want to be able to create a lot more content for you guys, shorts, long form threads, put a lot more emphasis on the research reports we're doing within VIX Insights. And the streaming just kind of takes up too much time. So there you guys go. But we got 2 minutes to go, ladies and gentlemen. Here comes TMF a little. Are yields coming down? A little bit, but this Lebu was the one that I wanted. That's the one I wanted the most. Like the TMF is still probably going to be pretty good, but I don't know. We'll see. There the market goes. There she goes. All right, let's see. We got to make sure you guys can hear this too. We'll do a little sound check once this thing starts coming in. We'll listen to Powell. I'll be taking my notes. And then again, yeah, we're going to get that YouTube video out for you guys later too. So again, just have notifications on for the channel. Builder starting to get the bid up. Yeah. Lebu just, dude, that's like $3 there, man. That's huge. This thing's up 9% right now. again, understanding these macro developments and what the Fed is saying how that can potentially affect other things is just critical to having success, guys. It's critical. KRE's trying to run. Is it? Ooh, hold on. We getting Powell? Oh, I don't see him yet. He's almost there. Here we go, ladies and gentlemen. All right, let's get the market up here. We're going to watch ES for this. He's about to make his grand entrance. Here we are. Nope. Oh, nope. The door just opened. Here we go. Here we go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially over the past year, while the labor market has remained strong. And that's very good news. But inflation is still too high. Further progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings, though at a slower pace. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation, and the risks to achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs to workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation.
It's right in front of you.
We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful? And ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored
Or anchored.
stable roughly? Would you disrupt that for the last half point on PCE?
You know, I don't want to get into complicated hypotheticals, but I would say that, you know, we're committed to retaining our current restrictive stance of policy for as long as is appropriate, and we'll do that.
Gina. Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really
That's
what I
right.
just mentioned, which is how long to
Wish
keep
I got
policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned, but that's something like that is what it would take. We'd look at the totality of the data, answer that question. That would include inflation expectations, and all the other data too.
Would that be like an acceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that. So it would be the totality of all the things we'd be looking at. It could be expectations. It could be a combination of things. But if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take, which would cause us to want to consider rate cuts. And those would be, two of those paths would be that we do gain greater confidence, as we've said, if that inflation is moving sustainably down to 2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned there would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, that's what we're tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and
watch
RKT. And
RKT.
that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. Part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%.
Bye-bye.
It's May now. Do you have time this year to
Great
cut
work.
3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see? in the first quarter. We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking at. Yeah.
And Mr. Chair, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will, we will put the thing, we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view. I think that, in fact, we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants and when it shows up for existing tenants or for in housing services. So
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that. No, I mean the active tool of monetary policy is, of course, interest rates, and this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Boris from Bloomberg. 2 questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like.
Maybe who's going to rant.
Lawyers,
that's a great
accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth that's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree. It's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter. And in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them is further away from goal than the other, then you focus on that one. Actually, it's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. As and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis.
You're welcome.
It's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire.
10-year.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy.
Good question.
Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your question, your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure. And we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say, most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
That's bullish.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up. And of course, he's Mr. Potential Growth, our star. Do you share that view? And would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy. That's not about productivity. It was about having more labor, frankly, both through in 2023, both through participation, also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year. And last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got, so you got more supply, but those people also come in. They work, they have jobs, they spend. So you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive. And, our evidence for that I went over earlier. You see it in the labor market, you see it in inflation sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So that's how I would think about it.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So GDP growth is about 2%. Inflation, employment is about 4%. It feels a lot like a steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria. Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things. And if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And, we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing. And we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December?
There's a significant difference between an institution that takes into account all sorts of political events and one that doesn't. That's where the significant difference is. And we just don't do that. I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So
exactly. Exactly. You've already done it.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think roughly. So yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. Good work, guys. Paying attention. I like it.
Nancy. Sorry. Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it.
I know. They all rip.
Headline core PCE peaked at 5.8. Now it's anyway, headline peaked at 7.1. Now it's at 2.7. Don't want to get that wrong.
No, you don't. Quick follow-up. Are current interest rates really doing that much, though, to fight inflation right now for those consumers?
Yes. I mean, I think that restrictive monetary policy is doing what it's supposed to do. But it's also, in this case, unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And so this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
I should have just market order.
Maxios, thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment. That's called market rent. And you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years actually to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, and it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expected that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So that you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. They have their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we will be careful and cautious as we approach the decision to cut rates. Whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy? Or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
You know, I said an unexpected weakening is the way I characterize it. So, you know, and I'm not going to try to define exactly what I mean by that, but you know, it'd have to be meaningful and get our attention and lead us to think that the labor market was significantly weakening for us to want to react to it. You know, a couple of tenths in the unemployment rate would probably not do that, but would be a broader thing that would suggest that that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to, you know, completing this process and carrying out Basel III endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
You know, there's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, you know, we have dissents, and you know, a thoughtful dissent is a good thing. You know, if someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, you know, that for most people, most of the time, that'll be enough. But I'm not. I mean, it's not, you know, frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I mean, I think we have a very diverse group around the table, frankly, more diverse than it used to be in many dimensions, more diverse both from the obvious, you know, gender and demographic ways, but also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question though. Thank you very much.
All right, ladies and gentlemen, that was a very, very, very interesting FOMC there. So again, those of you guys that were paying attention for over the last week here, the Lebu was that's just screaming risk on right there. So those of you guys that were able to take advantage of that, I mean, I couldn't get a fill on it. So the TMF coming back down, still like it. Obviously, the thesis remains the same. A lot of things are pointing to yields down in the near future, so we'll see if we can take advantage of that. But guys, we're going to be having a YouTube video coming out later tonight, probably around 7:15 p.m., something like that, Eastern, recapping and explaining everything that was said in here. So make sure you guys have notifications turned on. So yeah, I mean, again, we've got a lot of fun things that are probably going to start happening over the next few weeks here. And again, I mean, I thought everybody was going to get caught off guard with that FOMC report, especially with the slowing of the balance sheet runoff. So again, we were right on that one. Let's see what continues over the next couple of weeks here. We have NFP Friday, which is going to be huge. We still have earnings after hours today, so that could move markets around a little bit. But yeah, if you guys want to hop into VIX Insights too, I mean, we talked a lot about bond yields recently. We're going to have something coming for you guys really soon as well. I mean, most people, Swing Kings for the win. Yeah, I mean, I'll send you guys that link there too to get 50% off all the education there. That deal's ending at the end of the month. So the first one there, that's going to be the education. And then the second one is going to be VIX Insights, that $15 a month research service that I provide you guys with all of the research report. We have one out right now. We're going to be having those single stock research report coming out this weekend. And I really want to try and get out for you guys the research report about interest rate risk in the market. Because again, I say this a lot and you guys see it come to fruition many, many, many times. Having that good understanding of what's going on in the market can lead you to those opportunities that other people just may not see. Like when I was told about the XBI chart and then we saw and then we started to see well, I thought Lebu had a little bit of a better risk to reward, but I mean, my thesis is a little different. When we start to see things like, all right, QRA, Treasury is going to announce the bond buybacks. We have the Fed coming out and potentially slowing the pace of the balance sheet runoff. We have the USD JPY situation. There's so many things that can point to potential trades for us that we have to understand. So again, I can throw that in here for you guys, but be on the lookout for that video later. That is going to be a fun one. Other than that, team, I'll see you guys.